Canadian real estate is now in the deepest correction since the 1990s. And not only that, there are other issues that are happening as more than 50% of variable rate mortgages took out in 2021 have been triggered according to the Bank of Canada. So this is an absolute disaster and a ticking time bomb that people need to be aware of and know what's going to potentially happen in the future so they can protect themselves against that eventuality. So let's get right into this. Canadian real estate now in the deepest correction since the 90s. Prices back to mid 2021 levels. And those of you that don't know, during the 1990s, over half of the financial institutions that have ever gone bust in history went bust during the 1990s, during the period from 1986 to 1995. So that is quite profound that they are saying we are in the deepest correction since the 1990s, and that is not something to ignore. However, people are going to ignore this, and I'm going to talk about that and a bull trap further on in this video. So Canadian real estate prices continue to fall last month. The benchmark price fell 0.5% to 713,700 in January. You know, if you put that in 20% down at today's interest rates, still just an absolutely insane amount of money. And put that average price in and then put the average salary that a Canadian gets in, and you just won't be able to make sense of it. So Canadian real estate prices, this is a chart of essentially where we've been. So the price peaked at $868,000 and now we're down at $713,000. And I'm sure a lot of people are underwater on their home at this point. A lot of people who bought in 2021, especially those who put minimum amounts down, those people are just absolutely screwed. Maybe they got mortgages that were insured by the Ontario Teachers Pension Plan Canada Guarantee. I mean, it's just absolutely mad the amount of risk in the system right now, which people are refusing to ignore, that is there though, nevertheless. And you can really see that that has come down significantly. And look at this compared to 2008, guys. You know, 2008 you went down. Look at this decline, clearly a peak, even looking at it compared to 2017. It is just clearly a peak, and you could definitely see a bull trap here. It could definitely happen. What could allow a bull trap to happen? The only way I really could see a bull trap happen is if rates are coming down, so bond yields are coming down, and that is allowing people to get into fixed rates at a lower rate so they feel a little bit better about getting into the market, because there's still an insane amount of people with FOMO that are just sat on the sidelines, and essentially they're just waiting for any opportunity that they can justify getting into the market. So if rates come down a little bit and then prices have also come down and then activity starts to ratchet up and their realtors on the phone going, hey, you know, there's a lot more buyers in here this week. Do you want to come and buy right now? And they're like, yeah, we'll come. So, you know, there's a ton of people out there, as unfortunate as it is, that are going to get run over by a bus in this crash, because essentially the people who buy later and later down the road, it's just disastrous for them. We know that from some of the reports from what happened in the US during 2008, and it was mostly prime borrowers that ended losing their home. So annual growth is the lowest in the benchmark's history. The annual growth rate continues to plummet further. The 12.5% decline is significantly larger than the 7.5% drop reported in the prior month. The 12-month change in price now reveals the sharpest drop in the history of the benchmark. It's a huge change from this time last year when record growth was approaching. And then it shows you this chart, and it shows you essentially where everything is right now. You can see that the growth has far surpassed 2009, and it's just gone straight down and plummeted right now. So that is not a good sign when you're talking about a market that has been artificially stimulated. You're talking about a market that is in a super bubble. that is dangerous for a lot of people, and people just aren't aware. I think a lot of people just don't even accept that Canadian real estate is in a bubble. You know, the recency bias, looking back to 2008, a lot of people are just going to think prices are just going to head higher again. They don't understand, or they don't even bother to go back and check why Canada kind of got away with 2008. It was just simple. In simple terms, it was just essentially the bubble was smaller. The bubble was very small at that point. So they were able to either make a decision, which was, hey, we could regulate things, get a hold of this right now so it doesn't cause a crisis in the future, or we could do the least painful option, which is let this thing carry on and inflate so it looks like the economy is doing better than it actually is. And of course, they chose option 2. That's always what seems to happen. But it gets to a point where it's so large where you can't do anything anymore. The amounts are so large that it starts to impact even inflation. And that's where we're at right now. So Canadian home prices are now 150k lower than the peak. Just how far have prices rolled back? The benchmark peaked in March 2022, as did prices in most local markets. Since then, prices have dropped 17.8% lower, rolling all the way back to August 2021 levels. It's a huge drop, with prices having rolled back more than a year. The absurd gains made over the past few years far outpaces the recent drop. While $150,000 sounds like a lot, prices remain 30.9% higher than in 2020. Technically, prices haven't fallen into the point where it can be referred to as a crash, and I think that's obviously debatable. But one thing that I do think is interesting that they highlight here is 17.8% decline. You know, if you took out a variable rate mortgage in 2021, you put, 20% down, let's say, you could still be underwater on your home purchase, because think about it. You've got fees to sell if you were to cash out, if you needed to cash out. And then you've also got the fact that a lot of people aren't even paying. They're not even paying the interest amount. They can't even afford the interest amount. So they've been triggered on their variable rate mortgage, and they're not even paying the interest payment of the they're not even paying the interest portion of their payment. They're paying less than that still. Their amortization is being dragged out further into the future, but they are paying interest on that. They're paying interest on all the interest money that they're not paying. I mean, this is just where it becomes financial engineering 101 for the banks, and they have just nailed it in terms of keeping that earnings looking good, keeping things looking good on the default side. And that just creates a bigger crisis in the future, because all they're doing is allowing their clients to dig themselves further and further into a hole that they're not going to be able to climb out of. And what ends this, whilst all this financial engineering and everything else is going on, you could still have that bull trap play out. But the thing is, unemployment is the last thing to go in terms of this bubble implosion that we'll see. And when that goes, that is the straw that breaks the camel's back, because then they can't afford the payments at all and they enter into default, and there's no chance that they're going to be able to sell and potentially even pocket anything. If they sold, they're actually going to be selling at a loss. They're not going to be able to do that. They end up upside down, and then the people who've continued to buy throughout 2022 and even this year in 2023, they could end up in exactly the same situation. So you could essentially have a foreclosure crisis similar to what we saw in the US during 2008 that plays out. So the banks, by hiding these defaults, by letting people stretch their amortizations, and it seems like they're doing them a favor, but they're not, because when they renew their mortgage, they have to bring everything in line with banking regulations again, and they won't be able to. This is creating so many crises that will play out into the future. You'll have a renewal crisis. This is how the foreclosures are just going to be there for a long time. So you're talking about 2026. You're going to have a ton of people from 2021 go to renew. They're not going to be able to renew. They're going to be completely screwed and possibly end up in foreclosure if prices haven't increased enough by then already. You really have to think this thing through. There's a lot of risk in this situation. So another thing I wanted to talk about, interest rates, a lot of talk right now I've seen online is about how home sales are at 2009 levels. And I'd already thought when I heard that, oh my gosh, the real estate industry is probably going to run and say, in 2009, that was when prices started going up again in Canadian real estate. So watch out. But here's the thing. When you look at interest rates where they are right now compared to 2009, you were talking about a tiny bubble in comparison to this one, and interest rates were down near zero. In 2023, you're talking about interest rates up here at 4.5%. Or whatever they're at, 4.25%. I can't even remember. I should know that. No, 4.5%. So they're up here at 4.5%. And essentially, you're trying to tell people that you're in this 2009 environment where prices are just going to go back to the all-time highs and everything's back to the races. I don't think so. So I think there's going to be a lot of narrative that could push a bull trap over the course of this year. And I definitely think one could happen because you see that happen in a lot of different markets. However, one thing which I'm looking at now which might crush the idea of a bull trap is this. So firstly, I just want to talk about GDP during that period as well. You can see that GDP actually started recovering in 2009. And then the interesting thing is, like we talked about, how they allowed that bubble to continue. But if you look at what happened in 2015, GDP starts to come back down. Trudeau gets in charge. Interest rates go lower. Public government spending goes higher. Deficits go higher. Debt creation goes higher. And you go off to the races, essentially, with that bump in the road during 2017. So that's really what's happened with GDP. GDP, not the most accurate measure at all for the economy because it includes public spending, debt creation, which is such a large proportion of the economy. So when you strip it back, look at manufacturing and other things that are really core parts of the economy, in my opinion, some of them have actually shrunk, which whilst government spending has increased. So anyway, this is what could crush the idea of a bull trap, is the fact that yields, they went down like nearly 1%, 100 basis points, and they've since just exploded higher and gone through this recent resistance level here. And their next testing will be around 3.61%. If they get higher than that, you could be heading to another high for the 5-year yield. So in that sort of situation, mortgage rates are going to be ratcheting higher again, which could be, a sign that things are actually, there's going to be no bull trap, essentially, because mortgage rates, there's going to be no discount. So a lot of buyers just aren't going to be able to buy. But part of me thinks that this will come at some point because you've just got such a large amount of people that sat on the sidelines. Maybe it doesn't happen, but I just believe it probably will happen. Those people need to get into the market in order to get to a point of capitulation at a later stage. And that's just really me being a market analyst, let's say. So, but that could not happen, let's face it, because sentiment could be absolutely wrecked by a recession or some other economic banking crisis or something else that happens. So really, really interesting time, I think. This year is going to be incredibly interesting to monitor markets, see what happens with bond yields, see what happens with real estate prices, and just wait for the eventuality of unemployment ratcheting up higher and higher and higher. And it will do, and it already is in some provinces like Alberta. So anyway, if you've enjoyed this video, you might like that one there. You might also like that one there. Thank you so much for watching. Thank you for all the support, and I will speak to you in the comments below. Take care.